to say that I don't think the Fed has been quite as good on its guidance and also communication as it could be. The key here right now is the Fed has to establish credibility that, in fact, it's going to control inflation. They've gotten way behind the curve. They basically, I've been talking about this since April of last year, that they basically had a flawed policy framework and as a result did not raise rates when they needed to. Now they're in a situation where in order to get credibility, they have to raise rates by even more and faster. And that's what we see happening. They have gotten it. I think they've changed their position. They're right to do what they're doing now. But the bottom line is once you sort of screw up in the past, you have to pay the price. And this means that, in fact, they have to be more aggressive. And it very likely is going to cause a recession.
Understood. Frederic, where are we in terms of neutral, and how far above neutral does the Fed have to go?
So I think that both the markets and the Fed are not thinking that the rates have to go high enough. So think about the following, which is, given inflation, this is a charitable view, that inflation, you want it to be 2%, that people expect it to be 2%, and you've gotten behind the curve, you probably need to go at least 2% higher than that. You have to actually have positive real interest rates. And so in this case, the Fed has to go, I think, at least to 4%. And in fact, maybe have to go higher because of the fact that they have to establish credibility. And that's exactly what happens when you're behind the curve. So this is a situation where I think the Fed is not quite yet there telling people that, in fact, they have to be even more aggressive. And the markets haven't gotten that either. So I think that that's a potential problem in terms of the communication and the forward guidance.
All right, Fred Martin here. Let me quickly jump in. So, in other words, you're saying the Fed's going to have to continue going hard at it, and probably more than people expect, as opposed to dialing back.
Absolutely, I think that this is exactly what you see. So let's actually go back a little bit in history. We had a situation where in the 1970s, late 1970s, the Fed really blew it, and blew it much, much worse than their mistakes that have been made recently. What did you have to do in that case? Paul Volcker had to raise rates to 20%. So the situation is not that dire, but you're in a situation where still the Fed has gotten behind the curve, was not sufficiently preemptive. They actually had a policy framework that was flawed, that did not emphasize preemptive policy, which I think is a hallmark of when the Fed does things right. And in fact, as a result, they have to actually raise rates by even more. They don't need to do what Paul Volcker did, but on the other hand, they actually need to basically be aggressive and convince people that they're going to keep inflation under control.